It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back. It is Managing Your Financial Future. This is a big treat for me today. Why is it a treat for me? Well, a couple of reasons. I shouldn't say it's a treat necessarily because Professor Rick Plum isn't here. That's not the treat part for me. The treat part is I've got Chris Lloyd from our Scottsdale offices here for the first time. Chris, I checked. You know the last time you were on our show was?
No, when was it, John?
3 years ago, almost to the day.
Oh, wow.
It was early April 2020.
It was annuities, right?
It was, good. Lifetime income and annuities. And everybody was masked up, they just started this whole thing. So I think we had to be like 20 feet apart. And we're talking, this was in our old studio. So welcome back. I appreciate you being here. Chris is a CFP professional, certified financial planner, professional, however you say it. Also ChFC, is that right?
That's right.
And do I have to say ChFC professional?
No, ChFC is just ChFC.
Now, ChFC is a chartered financial consultant.
That's exactly right, from the American College.
And what are those designations? Is there a big difference between those two? I figure there has to be something.
You know, actually, there's not as big of a difference. When I was first starting in the business, the ChFC was more popular as the financial planning designation in the industry.
Yeah.
And so that's the one I got. And then years later, I picked up the CFP professional designation.
That's right. And you brought some news, too, that said the Certified Financial Planner designation is like 50 years old now?
That's what I read on their website. That's
50?
What they've been promoting, yeah.
Wow. It's come a long way.
Absolutely, no doubt about it. They like to say there's about 95,000 CFPs across the world because it is an international thing.
Wow.
And they say that it represents about 20% of financial advisors. My math has it showing a little bit less than that when you consider other people who aren't financial advisors, but other registered licensed professionals.
Yeah.
It's a little smaller, but nevertheless, there's a good number out there, and I think it's a really great qualification to look for when you're talking about looking for a financial advisor.
I happen to agree, and I think we've found as the years go on, it's become more and more important. Because people, when somebody's managing your money, whether they're just doing your investments or they're planning or whatever it is, there's a fiduciary responsibility that they have. And to have a designation like that behind their name is very important.
Yeah, they like to talk about their 4 E's, and one of the big E's is education.
Yes, the 4 E's.
And I think that really is what it boils down to. When you're looking for a financial advisor, you're looking for knowledge and experience that you don't have. That's why you're hiring somebody potentially. And so the CFP program and the ChFC program, for that matter, all about education. And you go through college level courses on things such as taxes and estate planning and investing. And so, you throw that on top of an MBA and a business degree, and you might learn something along the way.
Well, I want my doctor to have an MD. I want my dentist to have the DDS. So if someone's working on my money, I want them to have. Now, I brought you because you're in town. You're not here that often, and it's good to have somebody, get another perspective of another advisor. But I also wanted to talk to you because you do kind of, you understand how the advisory world works, and you understand where advisors can add value. We used to do, you've been in the Phoenix area for what, 20? How long?
A little over 20 years.
20 years. And you've been associated with us for about that long or so.
Yeah, it's funny. I like to say that I've worked with the Lucias since the early 90s, but I've worked for them since 2006.
Well, we got our first radio show in Phoenix all those years ago.
That's
like
right,
2000.
Yeah,
something like that. And so we used to do these financial fests. Do you remember that? You were part of those.
Yeah.
Yes, Ron Cohen and those people.
Sure.
In Scottsdale and Phoenix. And one of the questions we got a lot, because it was people from all over would come, and they would come up and hear us talk and things like that, and they would ask questions. And one of the big questions was always, well, why do I need a financial advisor? Right. I mean, I'm here, obviously, and a lot of our audience is that listening to this podcast they either work with you or somebody with Lucia Capital Group, or they have their own advisor. But the question comes up: why do I even need one? Maybe we could talk about that in kind of broad categories for just a moment.
Yeah, rather than just my opinion, I'll tell you that Morningstar and others have done some work around that. They've done studies periodically, and And when they look at it, most of the time the decision to hire a financial advisor, because most people, while they're just accumulating money, they're focused on growth. Most people are what they would call do-it-yourselfers, self-proclaimed do-it-yourselfers.
Sure.
A very high percentage, like 75% or so, according to the studies. And that number drops significantly when those same people are faced with a big financial decision, things like a big inheritance, selling a business, or the number one reason, retirement.
That's it.
When people get serious about retirement, then all of a sudden they recognize that they may not know everything they need to know, and then they may not want to start looking for a professional.
Well, it gets real at that point.
It absolutely does.
I mean, it's one thing to spend 20, 30, 40 years growing your money.
Right.
And I hate to say this in broad terms, but, growing your money, throwing it in your 401k and letting it ride and just letting compounding do its thing, that's... I think as long as you do it, it's not that difficult. Am I wrong?
You're right about that. And, when you're first starting out, it's a smaller amount of money.
Sure.
But as you've gone on 20 years or 30 years and it's grown and grown and grown,
the stakes get bigger.
And so as a friend of mine once put it, when he was looking to hire a financial advisor, he's like, look, this is my life savings.
Yeah.
This represents and he's talking about his wife as well, their life savings.
Sure.
This is what they've worked hard to save and build, and they don't want to, can I say screw it up?
Sure, you can say screw it up because that's what can happen.
and so they're within that 15 years of retirement.
Yeah.
They can see it on the horizon, and so they're going, you know what? I want to hire a professional to help me out with making good choices for the next 15 years and beyond.
Well, it's a good idea, and it's not so much about rate of return, but I think people, you talk about people who, when they're younger, they don't have as much money. Well, if you have $1,000 and you lose 20%, you got 800. Okay, that's not great. But you get $1 million and you're getting ready to retire in 4 years, and you can retire in $1 million, and now it's down to 800,000 because the market's just tanked, and you don't know what to do.
Right.
And so I think what you're saying is that an advisor can at least guide you, and I don't want people to think that you guys are hey, come with me because I can get the greatest rate of return. That's not what it's about, is it?
No, it's about making good decisions. So, it's about making choices along the way. If you think about going from that growth accumulation phase that you were just talking about to the retirement phase, in the growth phase, you may have learned about asset allocation. You may have learned about investing. There may be some fund families you like. You may be pretty good at it, right? So there may be a lot about investing that you already understand and do well. When you start to think about decumulation, when you start to think about taking withdrawals from your portfolio or getting closer to that point, now it may be time to tweak that asset allocation. I can't tell you how many 50-year-olds have come in and said, hey, I'm going to retire within the next 10 years, but they had the asset allocation of a 30-year-old. Right. Or even worse, somebody who's 65 and they have the asset allocation they had when they were 30, So you got to think about asset allocation. You got to think about, okay, where's the first dollar I'm going to withdraw from? Am I going to withdraw from IRAs? Am I going to withdraw from after-tax accounts, Roth accounts? You start thinking about those things. You start thinking about Social Security decisions. You and Rick talk about that all the time.
Absolutely.
That makes up such a huge part of most people's retirement income. It's no wonder you guys talk about Social Security optimization all the time. It makes all the sense in the world when you understand how important that is.
Well, and they should be asking those questions. When I retire, if I retire and I don't know what to do, right. I've got money in an IRA, I got money in a 401k, I got personal money, I got Social Security coming in. Maybe I have a pension, or there are 50 different decisions. Where do I take my money from? And those are some of the things that you talk about. You mentioned too, or at least you told me about some studies that it says only 11% of pre-retirees have a written financial plan.
Right.
There was a Wells Fargo study. What was that? There was a 2017.
Yeah, 2017 Wells Fargo study, and they say 62% of pre-retirees have not tried to calculate how much money they need in retirement.
How scary is that? I mean,
right?
Really?
No, absolutely. Yeah, you got to have some idea of where you're trying to go if you're ever going to get there.
Yeah.
Right? It's that old saying of what is it? Plan to fail, fail to plan.
Fail to plan. Yeah, I forget who said it. John Wooden or Confucius or somebody.
Somebody.
But whatever it is, it's a truism.
Absolutely.
Now, retirement. People start to see as they get closer. to retirement, that these are big decisions. They're going to affect them for the rest of their lives.
Right.
You don't have that paycheck coming in anymore. You want to enjoy your life. You don't want to be sitting there worried for the next 30 years about where the next check is going to come in. You said retirement is more complicated than just, sitting back and watching the investments grow. I mean, it takes one set of skills to grow your nest egg, but Chris, it's a whole different set of skills when the process is reversed and you got to start taking money out. Building wealth is different from keeping wealth.
Oh, absolutely. We mentioned the American College earlier, and they have a program for retirement income planning along with their ChFC program. And in the retirement income planning program, they've itemized 18 different retirement risks that exist.
Only 18, huh?
18. And all these things are things
18.
you and Rick have talked about over the years. There's nothing new in any of that to us. But knowledge and experience matters. Last night I was having dinner over at Carver's. I like to go over there, and don't tell my cardiologist, but they have a nice
I love Carver's.
French dip. It's really good. And those people over there are so nice and do a great job. And so I counteracted the French dip with some red wine, if that helps.
No, that's good. That balances it out. Right? You got the resveratrol and okay.
But anyway, I was sitting next to a gentleman, and we got to talking, and he was talking about retirement planning and all that kind of stuff, and financial advisors he's used over the years. And he literally says, "Look, I'm looking to hire somebody sometimes." If I'm looking at a financial planner because of experience, I want somebody who's got some gray hairs, who have lost some hairs in my case, right? Who's been through the trenches, who was around in early 2000s, who was around in 2008, who's lived through some things,
sure,
because that's helpful to, they've seen it before. And I told him our little tagline of, you retire once, we help people retire every day. He said, that's a great tagline. That really resonates with me.
Well, it does. It's like you see a doctor come in. Not that the young person may not be, good, but if you feel good if the doctor has seen a few things,
right?
I like to compare it to that. So why should people consider hiring a financial advisor?
Yeah, I think it's like anything else. Why we hire anybody, it's because we recognize there are some things we don't know.
Yeah,
right? And when we recognize there are some things we don't know, then hiring a professional to do those things makes a lot of sense. And so when we get into the complexities of retirement planning, as an example, retirement income planning specifically, then we want to talk to somebody who's been there and done that before. And John, it's a collaboration. I never pretend that I know everything. We're talking about these designations and all my experience, and that doesn't mean I know everything.
No,
I have to recognize what I don't know.
Yeah,
as somebody who's trying to be a good advisor for people, I have to recognize that. And when working with clients, one of the things I love is when they repeat back to me things we've talked about in the past. When I know that they've grasped the concepts we've discussed, and they're then teaching me or reaffirming with me what it is we've talked about in the past.
Buckets, can be a theoretical concept until it's explained, and once people understand that, right, that's probably one of them.
Right. Absolutely. Buckets is our vernacular for retirement income planning, and it's a very visual approach, and people love the visual approach because they get to see, all right, here I know exactly where each withdrawal in retirement is going to come from, where my income's going to come from.
Well, yeah. I mean, is it okay? So you're going to take some out, some out of the IRA. We'll take some out of the personal. Maybe we'll blend some of that for now. And it all works around tax management and all the stuff that people don't want to think about. Do you ever get people who are say I'm kind of embarrassed to show you what I've done. I haven't done everything I need to do. Are there people who don't want anyone to see, like, criticize their what they've done so far? You know what I'm saying?
Of course.
I'm trying to say it in a nice way.
Of course.
Like they don't want someone looking at it and say, "Gosh, that's all you've got." I mean,
of course. Sometimes really interesting thing with people who retire with big pensions. For example, I work with a lot of former police officers. My dad was a policeman, so I have a soft spot in my heart for police officers. And those police officers will sometimes come in with the approach of, I know I don't have much money compared to your typical client.
Oh, man.
Because their deferred comp plans aren't as big as a 401k might be for somebody who's been an executive their entire lives.
Sure.
And so I'm quick to point out to them, okay, I recognize you don't have that big pile of money, but you know what you have that I don't have is you've got this big pension over here.
Some nice security there.
Right.
Yeah.
And if it's an $80,000 a year pension, even using that simple 4% rule of thumb math in the back of your mind, you can say, well, that's like having another $2 million in your pocket. And I point that out to them, and that's from their hard work and time served. And
sure.
so that's the thing. And then where you were going with it is the other side of the spectrum, somebody who says, nope, I've made all these decisions, I know everything, and I'm not really open to advice, but yet here they are talking to a financial advisor. So that happens occasionally, but not most of the time.
Yeah, well, as we said, it gets real. You're all of a sudden faced with a whole lot of decisions. Kind of like when you become a parent, you think you know how it's going to be, when the kid comes along, I'll be fine, I'll be okay. And then when the kid actually is there, or even just a couple months before, you start to get nervous. And now all of a sudden you got a kid and you think, I have no clue. I don't know. What do I do?
Right.
I'm just winging it,
right.
Which is what most people do with kids. But when it comes to retirement and somebody says, look, I built up my nest egg and I can retire on this, but I wake up every day and I keep thinking, well, what if the market drops by 20% and I just retired 2 months ago?
Right.
I mean, you saw that situation, Chris, a year ago, almost from like the first of the year. I don't remember how far down the markets were last year, but it was in the 20% something category. There were people who retired January 1st of last year.
Sure.
That had $1 million or whatever. And they said, I can handle this. I'll take 40 grand a year out. No big deal. And I'll rebalance. I don't think too many of your people were too concerned about that, were they?
No, it's never any fun. Let's be clear. It's never any fun. Nobody likes losing money. Right. It's like nobody likes writing a check at tax time, right?
Yeah, right.
So it's never any fun. But no, when you come into the situation prepared, when you understand that the market can drop by 20% tomorrow for reasons we can sit here and think of, and we can think of a lot of them, John. We can sit here and look at the news and go, holy smokes, why would he have any money in the market, right?
Oh, my gosh.
But when you come into the situation with that attitude and understanding that it can drop for 20% by 20% tomorrow for reasons you can think of and reasons you can't. Nobody was thinking about COVID when COVID happened.
Most of the times it's reasons you can't.
That's exactly right.
You never
Most
saw
of the time
coming.
it's those reasons we didn't see coming. Yeah. And so when you are playing defense, the way I describe buckets sometimes to people is we're attempting to play defense while we're playing offense. Yes, you have some things in there for offense, long-term growth, bucket 3 type assets, but the most important buckets are really bucket 1, playing defense. Mm-hmm. That's the most important bucket. And by having a asset allocation that has some conservative assets, are you giving up some upside returns potentially? Maybe, but not nearly as much. And really, the allocation from buckets is going to be similar to the allocation you get from a traditional asset allocation model approach. Many times, not all the time, but many times.
Like a systematic withdrawal kind of thing?
Exactly. Yeah. So you may end up at 60-40 if you did a systematic withdrawal approach versus a buckets approach. The big difference is we've already decided where you're going to withdraw the money from.
Yes.
And we're only going to pull out of that fixed bucket in order to supplement your Social Security and pensions.
So it gives people, I think, a sense of maybe that they've got some control. If you're just taking money out of your equity portfolio and it's going up and down and it's volatile just like it was last year and you're withdrawing money from a declining portfolio, you're really not in control.
Right.
I mean, you're taking the money out, but you're watching that nest egg drop considerably. But I think if you, as you said, if you're taking it from a bucket 1 instead, I guess it gives you some sense that you've got some control over your life. You can't control what's happening with the markets, but you've got your income.
Right. Well, what you're referring to is the behavioral finance aspect of buckets.
Exactly.
And it's goal-driven investing. That's another name for it that's often used in the behavioral finance world. And that's what buckets is. We've defined the goal for each bucket of money and matched the assets to the income liabilities of that bucket. Mm-hmm. And by doing that mentally allows you to allocate that money, right? Even if it's all in the same account, it's mentally allowed you to allocate that money, which ties your mental response to it to the objective you've given it. Therefore, okay, it's okay that bucket 3 has gone down because that's not money I'm going to touch for 15 years, as an example.
Yeah, exactly. And I do think that I can't say the word peace of mind. Forgive me. I think they would edit that out. I got to be careful what I say.
I'm glad you said it instead of me.
No, let's put whatever other phrase you want. But it's important to people. Now, I don't, another question people often have when they're considering a financial advisor has to do with how much they're going to be paying in fees. There are people who have heard, that, oh my gosh, it's astronomical. But then you see people saying, oh no, it's not going to cost anything. Every person's situation is different. So I'm not going to ask you, what does it cost? Because who knows? But can you give me sort of just a broad generalization of like the structure or what people should think about? Let's talk about that maybe.
Yeah, I'll answer that the same way I answered it for the gentleman I sat next to at dinner last night. So he said, well, I want to ask, do you guys as financial advisors, do you charge a flat fee or do you charge a percentage or, do you get paid based on the investments you use? And, and I told him the honest response is we've built our platform to have the flexibility to do any of the above. It depends on the clients. Everybody's situation is different. And so some clients who want to manage their own assets, they may only want to pay for financial planning advice. They may only want this feedback that we're talking about here in terms of retirement income, knowledge, and experience. That may be all they want. So that might be a flat fee person. They're only paying a financial planning fee.
Mm-hmm.
Now
they're paying for advice.
They're paying for advice, right?
Yeah.
Now they then have the responsibility of executing their investments according to that advice, and sometimes that's the challenge.
So they have to do all their buying and selling and deciding what to hold and all that stuff.
That's exactly right. And sometimes there becomes a disconnect because then they start second guessing what it is that was discussed. Mm-hmm. But it can work, and it works fine for some people, and so that's an option that we make available in terms of that. Most people, though, want us to apply our investment experience in addition to our financial planning experience and knowledge. And so they want us to manage the assets in addition to financial planning advice. So they might pay a percentage, of their assets that we manage for them. And then lastly, whether it's somebody that fits in those first two categories or somebody who just wants a specific type of product, some products are commission-based. Some that exist there, the majority of products that are available in a particular category might be commission-based. And so we'll discuss whether or not that makes sense for that person. And we'll fully disclose this is a commission-based. There's no secret, right?
Right, yeah.
and if it makes sense to us and to them and they want to go that route, then we might implement a product like that that's commission-based. And go ahead. Sorry.
No, you talk about products, meaning what comes to mind is a lot of insurance products. Things that like annuities, right. I'll mention annuities.
Right.
And those get a bad rap, but they also are fairly criticized.
Right. Well, that's the example that I gave to him because we had been talking about interest rate risk and the fact that it wasn't until the last year or so where interest rates moved up quite a bit. And we've been waiting for almost 15 years for that to happen and all that kind of stuff. And he talked about all the cash he'd been holding in his portfolio over the long period of time and all that kind of stuff. And I said, well, there's a perfect example of where had we been working together, I might have said to you, okay, instead of holding that $1 million of cash,
while it was paying no interest,
paying virtually zero during the last several years, would you like to take part of that cash and perhaps purchase a short-term fixed annuity that pays a much higher rate? And we will compare that rate to CD rates and see if it justifies that, right? And it's got to make the decision has to make sense for the client first before anybody else, and that's what matters. And he went, oh, I never would have thought of that. That makes all the sense in the world. And now I would have told you, I think his name was Chip, I would have told you, Chip, that this product pays me a small commission, so you would know that we're getting paid on that, but you don't have to pay an advisory fee, so to speak, on that.
Sure.
And would you have been okay with that in that instance, now knowing what you know about that? He said, yeah, I would have done that.
Well, sure. I mean, you consider, well, what am I getting out of it? Oh, am I getting, X percent more than I am out of this? Well, I don't care who's getting paid what or how much. I'm happy with what I get. It's like a CD. I mean, there are fees, quote unquote, on a CD. You don't actually pay it. It's just you're getting a slightly lower rate for that CD. We've talked about this before. than you normally would because somebody's getting paid for that, to provide that seed.
Right. So it's all about, just honest discussion and disclosure is what it should be all about anyway. That's what it should be about. I know in some cases it's not, and I know some people out there have had really bad experiences with different things in the world, and I respect that. And so we have flexibility. That's the point I would want you to take away from that.
Yes.
Is there's flexibility to work with you however you'd like to work with us. And if it makes sense for us to work together, we can figure out a way that makes sense.
Well, sure. You go to a restaurant. You can order a cup of coffee if that's all you want. I just want a quick cup of coffee. I don't need anything else. Right. Or maybe you're hungry. Well, maybe I could have a piece of pie. Well, okay. But if you're hungry or if you ever want to come back, I got a whole full meal,
Right. Okay.
I try to put things in terms like that, but it's almost like a menu of stuff and whatever it is that you happen to need at that time. But as you said, the important thing is that it's all communicated.
It's honest discussion. It's collaboration. I love the word collaboration because I might be guilty of over-explaining some things, John. Maybe you've heard that about me.
I have on occasion.
Yeah. But it's because I want clients, the people I work with, to understand and be able to work with me. I mentioned earlier, I love it when somebody explains back to me something that they've learned from prior discussion. Recently, the wife of a client that I work with she's about to retire. And when he retired a couple years ago, we did a whole analysis of his pension options.
Yeah.
And they came, when we talked recently about her pension option, then they came to that discussion armed. He'd already calculated the break-even point.
Wow, right? Look at that.
And he's telling me here, well, I've calculated the break-even and this, but can you do that other little calculation you like to do on these? The internal rate of return calculation he was talking about.
Oh, man. Wow.
And so we're doing that analysis together, and that demonstrates the amount of collaboration we have on things like that.
Now, people don't have to necessarily get that involved.
No.
But I think you would agree that you shouldn't ever buy a product within your plan. Your plan shouldn't have a product in it that you don't understand. You don't understand why you have it or how it works, right?
I agree.
I mean, you wouldn't let somebody buy an annuity without understanding. I mean, would you have them say, now you understand why I'm recommending this? They need to know that. They shouldn't say, well, I don't really know why I have it.
Right. Now, I can't always guarantee somebody fully understands what it is.
No, not fully,
right?
but just why.
But I absolutely would want to make sure that they understood it and would do my best to help them understand it. And the best indicator of whether or not they understand it is when they repeat it back to me.
Yeah.
And if they explain it back to me in a way that is correct, then I know, okay, they've got it. And if they don't, then I know, we need to revisit that. And that happens. That's a little test we do, so to speak, to make sure that we're on the same page.
Sure.
I listen for that. And if they say something that's different than what I explained, then we'll revisit it and tweak it until we get to the.
Well, yeah,
we have to be on the same page, is what it boils down.
You have to be, and the fair rap against annuities and against people who push like quote unquote commission products is that they're just pushing it so I get a commission. They're just telling you, hey,
that's right.
You need this, you need this, you need this. Boom, you're out. But that's not how it works.
Right.
I mean, you could say I believe you need this, whatever the product is. It's a tool, right?
Yeah.
You need this, and here's why. And then you make the decision. What do you think?
Right.
And even if, some people might say, I understand why I need it, but I'm just not comfortable with that.
Right. And there's more and more fee-based annuities out there today than there were even just 5 years ago. And so those are things we get to compare and contrast and discuss. So, it's, like I say, flexibility so that you can work with us however you might choose to work with.
Chris, thanks so much.
Thank you, John.
For being with us. Chris Lloyd, CFP professional, ChFC professional, I guess. I'll throw that in because who knows? But that's what you are. You're one of the wealth managers here. You're kind of a senior vice president. You've been around for a long time. People want to get in touch with Chris Lloyd. Actually, you can just call the main number, the 800-644-1150 number. You work in the Scottsdale office there. Been there a long time. A lot of people listening, I know, in the Phoenix/Scottsdale area. And you've been there for a long time, but you still talk like you're from Tennessee.
That's true. I do occasionally have the twang that comes out. So
yeah, so
it is what it is.
You got the mountain brogue in you, but you know what? The Tennessee, you can leave Tennessee. Tennessee never leaves you. It is Tennessee, right?
It is Tennessee.
That's what I thought. Anyway, give him a call or Professor Plum. You got Professor Plum right there working with Chris. 800-644-1150. You want to find some of this stuff online? Go to luciacap.com, LuciaCap.com. And of course, don't forget to subscribe to our podcast. You can go to iTunes, you can go to Spotify. We're all over the place. Make sure you download. You've been listening. You said on your walks. What are you doing?
I have to confess, I wasn't listening for a while.
Wow.
And a client reminded me that he used to listen all the time while he was doing other stuff. And I'm trying to do a better job health-wise, so I've been walking and every day. And so on my 2-mile walk, I get you guys up and running at the beginning of the walk, and you finish right when I finish. So
look at this. We're probably right on time. Perfect. So when you're listening to this, when you're listening to this in a week or whatever it is, you're probably just about getting home about now.
There you go. Exactly right.
So we'll say hello to Chris Lloyd. We're going to give a shout-out to you as you're listening to this later on. Thanks again to Chris. We'll have Professor Plum back next week. In the meantime, as I said, you can subscribe to us, go to iTunes, or go to Spotify and download our podcast as often as you can. For Chris Lloyd, ChFC/CFP professional, I'm your podcast host, Johnny Dean. Thanks for listening. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Rick Plum and Chris Lloyd are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.